Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping on every order, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 40,000 new customers who have recently made the switch to SD Bullion. Why pay more?
Hey everyone, this is Elijah Johnson and Eric Dubin with your SD Weekly Metals and Markets Wrap, and our guest today is Dave Kranzler from Investment Research Dynamics. Dave and Eric, thank you so much for joining us today.
Oh, thanks for having me back on again. I love doing this show.
Great having you, Dave.
All right. Now, our first topic, we can discuss this week's price action in the precious metal markets. It seems like this has not been the best week for precious metals. Gold is back below $1,300, and silver is actually dipping below $17. What is your perspective, I guess, starting with Dave? What do you think is driving the price, David?
Well, it's just another in a long line of wash, rinse, repeat paper gold cycles where the price starts to move higher and the bullion banks on the COMEX and in London feed paper into the price rise, and they short this paper, and they're naked shorting this paper because there's not gold that backs this paper, according to the terms of the contract. And they can get away with it because the guys who take the other side are primarily the hedge funds, and they're just speculating on price momentum. They never take delivery of the gold. So you essentially have a two-tier price market or market going on. You got the physical market, and then you got the paper market, and this is the paper market driving the price. I actually, in my issue of the Mining Stock Journal 2 weeks ago, I said right up front to the subscribers, there's a price hit coming. It's very well telegraphed right now. So put some hedges on if you're worried about it, or, hold on to your cash and stay out of the market for 3 to 4 weeks, because I can guarantee you they're going to start taking down the price. And lo and behold, about a week later, that's exactly what they did. They started taking down the price. I look at the net short position that is in the Commitment of Traders report for the commercial trader category. The commercial trader category is primarily the banks. They'll tell you they're only in the swap dealers category, but that's nonsense. They're also in the producers and hedgers category, because that's how they get away with their huge short positions on the COMEX. They go to the CFTC and say they're hedging out positions in other parts of their gold trading operations. So the net short actually, the following week after that Mining Stock Journal, where I told my subscribers there was a hit coming, the net short position of the commercial trader category hit an all-time high. So conversely, I don't know if the hedge fund net long position was at an all-time high, but it was at an extreme high level. And going all the way back for well more than 10 years, whenever you have a Commitment of Traders report that's set up like this, they always smash it. And so, for instance, that flash crash that we saw, I believe it was yesterday, that's the banks going in there and setting off the stop loss limits where they know where the hedge funds have them set. And it causes an avalanche of selling, and it pushes the price down, and the banks go in and they cover their shorts, and they make a lot of money doing that. So that's what's driving this. It has nothing to do with the actual demand characteristics in the physical market. I see reports on that every single day from the Eastern Hemisphere: India, China, Vietnam, Turkey, and often several other countries show up in this report, and the physical demand in all of these countries is very strong right now. So it's just more evidence, just another week or 2 or 3 in a long line of a series of weeks where the banks manipulate the price downward with paper. And it's not coincidental that it occurred during the same week that there was an FOMC meeting, and the Federal Reserve issued some threats about their balance sheet and interest rates that no one believes. But if they push down the price of gold and spike up the dollar, which is what they did on Wednesday, people look at the markets and say, "Oh, maybe she's serious this time."
In the trader community, watching how gold and silver have been trading since July, they've been primed to sell off when this kind of a catalytic event of the FOMC comes in and hits this week. So it's really not. I mean, we went from 1204 on a continuous contract basis for gold in early July after all of those crazy flash crashes we were seeing, and we added $150, $160 in the price of gold in the span of 2 months, and peaked out earlier this month. So, I mean, we've been through this cycle so many times when it comes to the rate hiking / balance sheet dance that the Federal Reserve does. We've been living with this for years now, and it is directly tied into how the whole bullion bank cabal basically manages this wash, rinse, repeat cycle that Dave just spoke of. They're integrally linked, and it's part of the S show that we are treated to. Unfortunately, the overall physical demand, as Dave talks about, is still there. We have all of the reasons why the underpinnings of an ongoing gold and silver bull market remain in place, but the management of all markets, not just gold and silver, but all markets, is so comprehensive these days that an alternative reality is pretty easy to paint until such time as it becomes completely untenable. And at some point that's going to happen, and that really is the understory with this whole FOMC meeting this week, because the Reserve basically announced that in October they're going to not reinvest the interest and not replace bond positions, treasuries and mortgage-backed securities that are held on the balance sheet of the Fed that are expiring, which in the near term are actually quite minimal. That's like a pimple on the butt of the balance sheet of the Federal Reserve. There's hardly any impact to the market to be able to do that kind of a trial balloon starting in October. It's something that is relatively safe for the Federal Reserve to do for public relations purposes. There's no way that the Federal Reserve can reduce in any material way to the tune of a few tens of billions of dollars of positions on their balance sheets anytime in the near future, because that would literally crash the stock market. And the economy has largely been a fictitious bounce out of the 2008-2009 crash by re-levitation of financial assets that made re-solvent on paper, in the least, the financial system, and in turn that filtered out into the rest of the economy with just rank speculation and so forth. And we have all these multiple bubbles all over the place. The housing bubble is returned, student loan bubble. It's really quite amazing how we're over 100 weeks of economic expansion with horrible underlying labor conditions that are masked by manipulated statistics, and people are hurting. The savings rate in the United States is falling. The Federal Reserve just cannot materially reduce their balance sheet over the coming 2 years or so. People are fixated on the headline value of Janet Yellen saying, "Oh, we're going to do something significant in October," that is not significant.
What is your perspective, Dave? Do you think the Fed has any real chance of really significantly reducing their balance sheet?
That's a little bit of a loaded question there, because I'm not quite sure if the Fed may actually reduce the size of its treasury and mortgage holdings. And again, I won't necessarily fully believe it until I actually see it happen, because they've said a lot of things that they were going to do, and I still don't consider taking rates from 0% to 1% an interest rate hike. I mean, that is not an interest rate hike. You're still below the rate of inflation, even at the way the government measures it, which we know is nonsense. So, the way that all this money, the way the QE worked was the Fed printed money and bought treasuries and mortgages from its member banks, and the cash that was printed went to the banks, and the treasuries and the mortgages were supposedly there to back that cash on the Fed's balance sheet, and that's why it's called quantitative easing instead of monetary supply, money printing. I mean, so if they say that they're going to let their balance sheet run off, which means they're going to let the bonds mature, what happens is the Treasury never pays down bonds. It always just refinances them out and rolls them forward. So if they're going to refinance the treasuries that are sitting on the Fed's balance sheet, that means that a check for the bonds maturing goes to the Fed, and then the bonds go away. So that did nothing to remove the money that was printed and injected into the banking system via the QE process. So it's unclear to me that, there's really going to be any kind of normalization here, and it's unclear to me that even if the Fed does, get rid of its treasuries and mortgages by letting them mature, that that the Fed's going to, on the other side of that, remove the liquidity from the banking system that they put into it, which was about $4.5 trillion. So I think it's a bunch of hot air, once again, coming from Janet Yellen and the Fed. And, until we actually see real action being taken on the part of the Fed, it's still much ado about nothing.
Yeah, and they're focusing on the roll-off. And they're making the argument that this is something that can be done over a long period of time. Well, the reality is that there's not enough buying interest in the marketplace to absorb the kind of $4+ trillion balance sheet that they want to reduce. It would take them decades to do it.
That's right. And here's the other thing. We're now starting to see, okay, so the Fed injected close to $2 trillion into the mortgage market, and that's what's caused the housing bubble. So it's unclear to me whether or not what the Fed is going to do is going to remove any liquidity from any of the liquidity that they injected into the system by letting their balance sheet run off, because technically the cash that was printed and injected into the banking system will not be removed from the banking system if the bonds simply mature. So I don't think the Fed can pull this off, because I think that it'll crash the system. I mean, the Fed injected nearly $2 trillion into the mortgage market, and that's what's caused the housing. That's what's caused the housing bubble, and it's a price bubble. It's not a volume bubble by any stretch of the imagination. I mean, in a lot of big cities, prices are higher now than they were in 2008, and the affordability of a new home has hit an all-time low. And so, I mean, that's, it's been a housing price inflation bubble fueled by this QE, and it's starting to lose traction. So I guess the issue of whether or not they can pull this off, I don't think they can, because the money that they injected into the system through their QE programs is losing its effectiveness. People think the housing market's really hot. Well, that's a bunch of nonsense. Price chasing in the housing market is hot, and houses are now the most unaffordable they've ever been in the history of this country. You'll see some data that'll show numbers to the contrary, but that's actually not true, especially if you look at new homes. The affordability index is at an all-time low. So the money that they have printed and injected into the system has lost its efficacy. It's lost its steam, and we're seeing the economy slow down. We're seeing, just the existing home sales report earlier this week. I mean, the National Association of Realtors blames it on low inventory, but that's nonsense, because I have posted charts several times that show that low supply actually fuels a greater number of housing sales, and vice versa. So in other words, there's an inverse correlation between inventory and number of sales. And the reason for that is because when inventory starts to get high, people who are going to buy decide to step back and wait to see if prices come down, which is what happens. So the way that money printing works is that once you print it and you stimulate artificially economic activity, if you don't keep printing it in increasing amounts, you're going to have a collapse. And so we're going to have a collapse no matter what. And if they want to collapse the system for whatever reason, then they'll do it the right way and pull that money out of the system that they printed up and injected into it. And I'm not sure that's exactly how this is going to work this time around. But either way, even if they stop putting money into the system, which they have been doing up until now in smaller and smaller amounts, the system's going to collapse anyway, because it's going to run out of steam from the original money that was printed and that stimulated the fake economic activity that we've had.
Now, I'd like to move our focus back to the precious metal markets. Now, Eric, I know before we started recording the call, you were talking about how the North Korean situation, this week we're seeing more threats going back and forth between President Trump and Kim Jong-un. And you talked about how really the North Korea situation is pretty much just a distraction, but it's going to be bullish for gold and silver. Did I catch your opinion on that correctly?
No, I wouldn't go as far as to say it's a distraction in the sense that, it's not likely that we're going to have a full-on war. We're probably going to have some kind of covert action strike on something. The kind of sanctions that are going around right now are not going to be able to do any material impact on pressuring the North Korean regime because it's in an existential crisis fight for its life. So whether the population is going to be pressurized and in turn the leadership being threatened, that's the goal, at least in terms of the strategy of trying to upend the North Korean regime and pressure them to change their policies. It's just not going to happen because Kim Jong-il looks at it as Saddam Hussein and Gaddafi and other examples and recognizes that any reduction to weapons of mass destruction program will basically ensure his demise personally as well as entire regime. So all of this bluster is going to have to lead to something. And it's possible that we might actually see some kind of a limited strike against North Korea. That is something that the marketplace generally has poo-pooed for the most part. There hasn't been a huge amount of perception in the general financial community that the United States would literally go to war, given the nexus of powers that are aligned and the kind of conflagration that would happen if we were to strike North Korea. Because, for example, the artillery batteries that North Korea has pointing at Seoul can kill over 1 million people in about a day in Seoul and then turn into a regional conflagration. It would just be unbelievable. But who the heck knows? The fog of war, it could, in fact, raise its ugly head and make things very complicated. And that has been a factor for why gold has been catching a bid since the crazy flash crashes that we saw in May and July, or June and July, excuse me. And ever since, we saw gold go up 160 some odd bucks. And part of that was North Korea. And I think that, as this year moves forward and we once again have yet again the discussion of the debt ceiling and the political turmoil on the domestic front in the United States combined with this geopolitical morass and the fact that this Federal Reserve song and dance has a limited shelf life, they're able to pull off this public relations campaign of giving the illusion that they'll be able to shrink the balance sheet. But not indefinitely, because they just can't materially sell bonds and mortgage-backed securities into the marketplace without crashing those markets. The markets aren't deep enough right now with organic demand to absorb anything of material. It's going to take them decades to reduce the balance sheet. All of these realities can be swept under the rug for periods of time, but it's going to be really interesting to see if, for example, bringing it back to your question about North Korea, if, in fact, the latest threats that are going on this week and possibility of escalation later in this year are enough to keep gold, for example, over 1,300. And the technical informed traders, the technical analysis speculators will look at that and say, gold couldn't get over 1,300 three times for the balance of this year. And then finally we got over it, and then, maybe we'll have, we as we record this Friday, kind of quiet horizontal trading in the aftermath of the bombs that went off and the FOMC's Wednesday parade and the flash crash for Thursday, and here we are. We're cruising around 1,300. If we're able to stick around 1,300 and creep above that next week on the back of what's going on with this North Korean crisis, that will probably be interpreted as something that will indicate to some traders that, the gold market's not going away. We have been struggling through massive manipulation for the better part of this whole year, and nonetheless, gold has actually performed reasonably well. It hasn't been a disaster show, even though it's been very painful. We have an artificially elevated stock market. We have the bond market that's still the largest bubble in world history. And we have bubbles everywhere, and then an artificial economy. And it's not something that can last forever. And I know it's maddening as precious metals investors to watch this and to see people will make countless forecasts and expectations on the future, and they don't come to pass given how massive the control grid is. And I don't use those words ill-advisedly. I mean, it really is truly a control grid that we have layered over our financial system now, where everything is so hyper-managed by the credit that comes out of the central banks. I mean, if you lay on a chart of world stock market action over the last 3 years with the central bank largesse of the top three central banks, the ECB, the United States, and the Bank of Japan, the Fed, there's almost a direct one-to-one correlation. And these markets they're a mirage.
Now, before we let you guys go, I was wondering if we could touch on one last subject regarding gold and silver mining companies. Now, U.S. senators are trying to introduce a bill that would attack U.S. gold and silver miners, kind of slap on more fees and regulation. Can you explain, I guess, Eric, first about this bill and how it could hurt gold and silver miners? And I know you've talked about this before, and if there's more regulation and so on, it actually would be bullish for gold and silver because the supply will be less.
Yeah, they're talking about a royalty scheme. So the 1872 Mining Act is the predominant law that is governing how mining claims are administered from BLM land, from U.S. Forest Service land. The federal government out in the West owns about half of the land. And so when the hard rock miners, who they don't pay royalties on the minerals that they extract from the ground, but they do pay leases. And this is something that the left and the environmental community, when they make their arguments and have their senators drumbeat this whole policy position for the last couple of decades, they basically ignore the fact that the taxpayers are not getting screwed. The mining companies are paying leases, and they're putting in that money directly into the United States Treasury. So, they're talking about maybe a 4% royalty structure that would be added on to any hard rock mining, so gold, silver, etc., copper. And the extra cost associated with that would certainly hamstring a good percentage of the gold operations that would no longer be profitable, because the profit margin is indeed thin because of high regulations, high costs of setting up mines and operating them in the United States. Dave and you and I were talking briefly before we started the show how, there's a public perception that the United States is a relatively friendly mining jurisdiction. But other than the fact that once you have a mine, you're likely to be able to keep it if it's in Nevada or somewhere where there are indeed, relatively speaking, friendly mining laws, the reality is that the cost of mining in the United States for gold and silver is really expensive, and regulations are really tight. And starting new mines is difficult. And so adding on a 4% royalty, which would probably be like the camel nose under the tent, where, eventually maybe we'll see 15% or what have you. That kind of thing is going to, if it were to pass, very seriously harm the interests of gold and silver miners in the United States, and then that'll curtail supply around the edges of the global marketplace, and in fact be a factor in having prices further supported. We already have seen a decade long period of miners scrambling and this decline in the market, or certainly by 2011 onward, where the price of gold declined from 1924 down. Miners are getting more efficient and improving, yes, but they also did a lot of high grading of their deposits and whittled away a lot of gold that, it's not as easy to find large deposits and high grade deposits, and mines are difficult to operate and very expensive, and the industry just doesn't have the kind of fat that the left and the environmental movement likes to parrot when they champion their policy objectives, and then the propaganda that they wrap around the bill that they're trying to push through Senate, for the example.
Camel nose under the tent. I love it. Where'd you pull that one out of?
Common phrase. I guess it would work better in Saudi Arabia, but hey.
No, I like it. It's a great visual. I agree with you. I've always, ever since I got into this sector of the market back in 2001, I've always been wondering at what point in time would the government start to try and annex some of the profits from the industry. And it's it's a similar thing as the camel nose under the tent. It's a slow government creep into the industry to help fund government's reckless spending, especially the reckless military and entitlement program spending. So
it's small money, though. I mean, they're not going to make that much money out of these royalties. I mean, it's a couple hundred
price of gold
million or something a year.
It's going to go, and it's a lot of money. I will note
maybe.
That,
I mean, even if gold were $6,000 an ounce, I mean, you're still talking about $2 billion worth of royalties or whatever, if it's a 4% kind of thing. I mean, compared to what the United States government spends in every minute. I mean, it's not going to be immaterial. It's not about money. It really isn't about money. It's about environmental ideology expressed through a justification for raising funds, and the kind of monies that will come from this program are trivial compared to what the federal budget is. So,
however you want to look at it, I will note that it's a bill that was introduced by Democrats, and so if Congress goes along party lines, it's not going to get passed anyway. So, I mean, I think if anything, maybe it's just a warning shot that the government's starting to put its eyes on the mining industry in general, and it wouldn't just be gold and silver mining, in order to find sources of revenue.
Yeah. Well, I mean, they're hitting every couch cushion available.
Right.
All right. Well, David Kranzler and Eric Dubin, thank you so much for joining us today. I guess before we let you go, did you want to share with the viewers, I guess starting with Dave, where they can find you online, and any last thoughts you'd like to add?
Sure. I'll start with the last thoughts. Again, this is this current price takedown in gold and silver. It's just another in a non-ending line of wash, rinse, repeat cycles. They become more and more well telegraphed because the banks know that they're doing it on behalf of the government, so the government's never going to step in and crack down on it, even though it's obvious manipulation. But I will say, and again, it was a chart. Eric probably saw it if he read my mining stock journal yesterday. There's a chart in there that shows that since December 2015, gold has carved out a nice uptrend of higher highs and higher lows. And I think this one will, I don't know how far down the price is going to drop. Probably mid to high 1200s would be my guess. Probably high 1200s. It'll add another point on the chart where you have a higher low, and then I think after that we'll probably carve out new highs. We did hit a post-election high right before they went to work taking down the price. So I think before the end of the year, that 1250 area will be ahead of the, above that. So again, I think we will. It's not a definitive forecast because it's impossible to forecast manipulated markets. But at any rate, You can find my work at investmentresearchdynamics.com, and on the front of the website, there's a couple links where you can find out more information about my mining stock journal and my short sellers journal. And thanks for having me on again.
Definitely. And Eric, are there any last thoughts you'd like to add?
Yeah, I basically agree with what Dave has outlined, and the underpinning of the market is here such that it's not going to fall apart. And next week it'll be telling just how far we drift away from 1300, and that whole technical perspective is important, even though technical analysis can inform very well in a gold market because of the manipulation. But at the same time, there's so many people that pay attention to it, the standard speculators, and they're part of the wash, rinse, repeat dance that goes on. So we have the backdrop of North Korea and all the crazy domestic politics and all the other things that are underpinning the rebirth of this gold bull market that's been going on for over a year. And it's not disappearing. We have illusionary markets, illusionary political dynamics, and a whole heck of a lot of plates spinning in the air, and then policymakers trying to juggle things, and it's untenable. The domestic politics front in the United States is going to get really ugly later this year. I mean, if anything, that could actually be one of the main reasons why Trump and company want to go and do something to North Korea, just as a wag the dog kind of distraction. But anyway, the bottom line is that we have seen these higher lows that Dave spoke of. We have seen the market kind of like in a stealth fashion hold itself together and rise through thick and thin and all of the attacks that we've been going through this year. And I don't believe we're going to see much downside. It's going to just be this kind of managed retreat phenomenon when we go up, and sideways actions to periodic scary spikes down when the cartel is able to engender really big attacks like those flash crashes in June/July of this summer. But we're no longer at $13 silver. We're no longer threatening to slice under 1,100 gold, even though it's been really painful to see us crash from 1362 earlier this month. But this gold bull market's still alive, and they can't kill it because the rest of the markets are all manipulated and illusionary.
All right. Well, this has been your SD Weekly Metals and Markets Wrap with Elijah Johnson and Eric Dubin and our special guest, Dave Kranzler.